Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and also in investing. I'm Stacy Smith. We welcome you to this program, and we urge you that if you are watching, to hit the like or the subscribe button. The Fed is going to be cutting interest rates in September, so one of the questions is what will the reaction be and how large will that rate cut be? Also, since they are going to be cutting rates, are there certain areas that you should be taking a look to invest in? We'll also take a look at this, and that is how important is the CEO to a company? And are options a good thing? And should you invest in them? And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. Thank you all again for joining us for The Bull, the Bear, and You. And, as you well know, I like to check in on the markets and see how they have fared since the last time we met, which was about 2 weeks ago. And since that time, the major indices have all posted solid gains, with the Nasdaq up nearly 7%, the S&P 500 advancing 5.5%, and the Dow up 4%. That's as of this past Friday. Now, those numbers add to the gains made for the year, and all of the indices are within days of striking their all-time highs. As a matter of fact, this morning, the Dow Jones Industrial Average busted through and set another new all-time high. Now, helping to push the markets higher at the end of last week was word from the Fed chairman that the time has come to adjust Fed policy, which means cutting interest rates. So from probably now until that happens, the focus will be on how much of a rate cut, 25 basis points or perhaps more than that. So Carrie, you have stated that if it is more than 25 basis points, the markets could react negatively. So my question, should you take any precautionary moves in your portfolio, or should you just wait to see what happens?
Well, the issues surrounding what you should do with your portfolio based upon interest rate cuts and what the Fed actually does is not how we approach this. We approach this kind of in a very similar way to how the Fed approaches it, which is what does the economic data say and suggest? And what we have experienced is really a lot of mixed data. I mean, more recently, the data has been supporting more of a soft landing type scenario where you have inflation that has been subsiding, but yet the economic data, the data points that tell us whether the economy is growing or contracting, have actually been okay. The biggest concern that I have at this point is really the employment situation and what's going to happen there. Are we going to continue to see those unemployment numbers rise? And that really then leads us to say, okay, how does that impact different segments of the market? And where do we want to rebalance? Where do we want to take our gains and rebalance into areas that might do well if we were to see more recessionary talk come into play? And just to reiterate, it's all about expectations. And right now the market is expecting 25 basis points. So if they were to do more, which I don't think they will, whatever reaction we get to that more so will be temporary because we're all watching the same data. And if anything, whatever it is that you're thinking will happen, the opposite will probably happen. So you can't really manage money we don't manage money around what is actually done. It's really the inputs into that, if that makes sense.
It does to me.
Since I tend to prognosticate more than others, Carrie said something that's interesting. If the Fed should happen, no one expects them to, but should they happen to cut 50 basis points instead of 25, I would suspect that would be bad for the stock market because I would suspect that it would read recession into a move like that, which would be bad for earnings and would not be good for the market. It would put some fear out there that's not there today.
I'm going to, and maybe this is for the next section, but I agree completely with everyone here so far saying that it's likely 25 basis points is going to happen. I think two things. First, every interaction that Powell has with the media always drives home that the Fed is data driven. So we have to look at the bits of data that come out that are really going to reinforce that 25 basis points. But as somebody who looks at the cost of capital and what companies are going to do in the future, and that's 3 to 5 years in the future, I'm looking at probably a 1% overall to 1.5% overall decline in the Fed rate, and over some period of time, let's say the next 6 to 9 months. And I think that's important for businesses who are making capital allocation plans. Are they going to buy? Are they going to sell parts of their business? What is the consumer going to do with this lower interest rate? And I think those are the things that should inform your view into what happens next, is not just this one moment in time, but the larger theme.
I'll wrap it up, Stacey. That's all right. And just because Carrie said that, the opposite might happen based on what you think, that doesn't mean you go and invest like George Costanza and do the opposite of whatever comes to mind. But the employment rate is, I think, again, what Carrie pointed out, one of the things we look at. And not just that the unemployment rate is going up, because jobless claims look pretty low right now. I think more and more people are sort of entering the workforce, which is a good reason for the unemployment rate to go up. If more and more people are looking for work, that could be a good thing. My bigger concern is, I think the economy is still humming along pretty well. There are anecdotal evidence of it not, but you can also find anecdotal evidence of the economy doing pretty well. So my bigger concern is if the Fed gets too far ahead of themselves, that's going to reignite inflation a little bit, and that could put them in a bind into 2025. So that would be my bigger concern going forward, and how you play the bond market and inflation as we progress through 2024 and into 2025.
All right. So if I'm hearing you correctly, even though if it's just a 25 basis point move here, there's talk of, and even I've heard some of the Fed governors say, well, we might be going, for 2 or 3 cuts still this year. If we get to that point, does that start to trigger that alarm about a recession, or is it just the size of the cut at that particular time?
Well, to Carrie's point and Frank's point before, and Kim's, it's data dependent. Why are they cutting at that point? Are they cutting because jobless claims have spiked, unemployment has spiked, and inflation is kind of plummeted at 2%? But inflation is still healthy above that 2% target line here. So if they really start cutting, and the economy remains pretty strong, I think it's pretty strong. I just think that's going to be that could reignite inflation in 2025.
Okay, we'll take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We are talking about the economy and investing. And as we've been talking about, Wall Street has been begging for a rate cut by the Fed, and the Fed appears ready to grant the street its wish. Now, when the Fed began raising rates, we talked about areas or sectors that could benefit from rate hikes. So, Michael, are there sectors that could benefit from a rate cut?
Yeah, in theory, technology stocks could benefit from a rate cut. They discount those cash flows, as Kim likes to talk about, way into the future, but they did pretty well when interest rates were rising too, for the most part. The biggest one that usually stands out in terms of following the interest rate cycle is utilities. Utilities are generally looked at, Stacey, as a bond proxy. Their revenues are for the most part regulated, so they pay a healthy dividend. And so if their earnings are pretty stable and your dividend is higher than what you get in the bond market, utilities have historically done pretty well in that area. Ironically enough, utilities are the third best sector in the S&P 500 this year. They're actually outperforming the S&P 500, broadly speaking. A lot of that is because of the AI boom we're seeing, and how many data centers are coming online now, and how many data centers are needed for all this chip manufacturing and the AI boom. And that it's going to require a tremendous amount of energy. But back to your original question, utilities historically have done well. And I guess real estate to another proxy has done well as interest rates have come down.
Anybody else have any opinions on this?
Of course we do.
Well, then I'd like to hear them.
The interesting thing about falling interest rates is it makes, as Kim mentioned earlier, it makes the cost of capital cheaper. And we've got all this AI stuff going. And the next step to this AI thing is for industry to use AI to increase their bottom lines, because they'll cut costs, they'll cut overhead, because this thing's supposed to do things that people have done in the past, and they'll get to redeploy their human capital to maybe more things that require brains instead of processes, which is what I assume this technology will do better than people. That all being said, down the road, which is what we all do, we look way down the road as to who's going to make money because of this. AI is going to create larger profits in a broad swath of corporate America simply because it's going to cut overhead.
Okay.
And I'm the long-term girl, right? 3 to 5 years. But here's the thing. I think interest rate cuts are going to drive shorter-term things, shorter-term areas this time, including housing and home repair and those kind of things. So if you're looking for something maybe 36 months out, this area has just been clobbered by high interest rates. And I think that we could see a little more spending in home building and home repair. So those kind of areas could benefit from lower interest rates.
So I'm going to throw kind of some new sectors into the mix here. When you look at early cycle recoveries, two of the sectors that we like to look at are industrials and basic materials. Yeah, not really sexy, not, technology. But to Kim's point, when you look at housing and you look at interest rates going down and corporations making investments, capital investments into building and doing, because now they can borrow money to do that, looking at the industrial sector, looking at the basic material sector makes a lot of sense. And what I really love about this is that generally those are the sectors that have been really beat up towards the end of, when you have an economic slowdown, those are the sectors that generally you can end up buying them a lot cheaper because they haven't run the way some of these other, particularly technology, to Michael's point, technology is kind of, it's the dynamics of how technology moves now, I think, is very different. There's a lot more consistency. It's going up when interest rates are up. It's going up when interest rates are down. And there's a reason for that, because it's demand, it's innovation, it's it's just kind of a new sector, quite frankly, even though it's not. So, I wouldn't overlook some of those boring names in sectors like industrials and basic materials.
It's
Can
funny
you
you
tell me
mentioned Carrie.
Go ahead.
Sorry, Stacey.
Go
It's
ahead.
funny that Carrie mentions early cycle sectors like materials and industrials. I mean, you can make the argument we didn't even hit late cycle yet in this economic. It's interesting to see how different this economic cycle has been because of how much manipulation went into changing everything due to COVID. That this is
Right.
just not following a traditional norm from an economic cycle standpoint.
Can you help me? What exactly do you mean by the basic materials sector?
Well, I mean, when you think about building something, right? Like you have industrials, which can be like equipment and things like
Right.
that. And then you have materials, which can be like chemicals,
Mm-hmm.
right?
Okay. Or
Like
mining
that's,
or something like that.
yeah.
Yeah. Okay. Well,
So-
I brought up. Go ahead, Kim.
Okay, real quick. I think this is really interesting because technology used to actually mirror people getting hired, because people would, you'd have to add more capacity to your servers and then buy new PCs for people. And that is why technology would go up with, rising tides of the economy. And we've kind of unlinked that for the past 20 years, where that has not been the case. And I think this is super interesting that everything's changing and investors have to be aware of it.
Okay. I want to go back to something Michael was talking about here, and that you were talking about utilities could benefit from a rate cut here because of all the power that's going to be needed to do the AI. If that's the case, would sectors that supply the materials for the power companies be something to be looking at as well? Or are they countered because of the push for green energy?
Let me add, in my alternative asset fund that I run, We
Mhm.
have 10% of our money in electrification commodity trading platform simply because it's happening. Now it's volatile. It's all over the place, but it's happening. And copper and some rare earth metals and names that I can't remember because I don't know what they are, like molybdenum and all these things. I don't know what these things are. All right. The traders that we hired to do this know what they are. These things are critical to the electrification process, whether we're talking about electronic vehicles, computers, phones, or NVIDIA's chips and whoever else makes these super chips.
Yeah. Okay. You brought up NVIDIA. I just thought I'd throw this out. It is supposed to release its earnings, I think, this week, perhaps on Wednesday. I presume that's going to drive the markets one way or the other on the initial release of the information. Am I right?
Yeah. And even today, it's driving it as people are selling their winners so far this year, because why not? And they're breathlessly waiting for 2 more days to see what NVIDIA has to say.
All right. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We've been talking about interest rates, but now let's change the topic here a little bit. This past week, one stock that was lagging surged ahead, and another stock that was riding high dropped significantly, and the reason had to do with one man. The stock that was lagging hired the CEO away from the stock that was riding high, and in the end, it was a $27 billion swing in market values of those companies. So, Kim, when you analyze stocks, you like to take a look at corporate leadership. You've said that time and again. But can a CEO make really this kind of a difference?
Yes. I don't know where I picked up this phrase. I think I'm embarrassed to say, some sort of reality TV show, but the fish stinks from the head. And I think that's a great way to put it, very directly, that CEOs matter. And we can look at how CEOs matter in a technology name that probably everybody knows, Microsoft. In 2012, Steve Ballmer was leading the company poorly. He was trying to make it into Apple because Apple was the hot item at that time. And he was trying to make phones and all these consumer things. And I actually, at my prior employer, started buying Microsoft stock when it was about $23 a share, because I said, it is not a consumer-oriented company. It is a business enterprise software company. Well, Steve Ballmer left, probably because the board said it's time to leave. And let's not forget, boards drive this decision. So in comes a pick that nobody wanted, an internal guy. What Wall Street really wanted, let's talk about this. This is so crazy. They wanted to break up the company, right? They said, do Office and those kind of things in one company, and then the rest of the, maybe Xbox in another company. They wanted to break up. But the new guy that came in understood what Microsoft really was, which was a business software company. And now look at where we are. So I think looking at that company can tell you the power of a CEO understanding what power there is within the company, and then making that come out and reward shareholders for believing and holding the company.
I think generally, Stacey, you typically see it manifest itself on the negative quicker than on the positive. So a new CEO coming in can really wreak havoc on a company or stock based on some of their decisions. And we saw that, and I don't know if we're allowed to talk about names here because you're.
Well, I was doing that for your benefit because I know that you and Carrie especially cannot talk about individual companies or stocks. So I was just kind of making it maybe easier for you.
Don't recommend them. We're not recommending anything here, but there's a large, I won't name the name, but a large sneaker manufacturer that I think we talked about one time in the show, that they pivoted away from selling. The new CEO pivoted away from selling directly to department stores and whatnot, and they try to do it on their own, direct to consumer, and that has had a very detrimental effect on the stock price and the consumer and the company as well. So you can see it really happen kind of quickly in the implementation of a new CEO. But a good CEO, to Kim's point, they're there for a while. There's a big bank that's had a CEO at the helm for the better part of 2 decades now, and he's done very well for the company, done very well for the stock. I get that he could be not everybody's taste in the news, but a good CEO will mark his territory and do very well over decades. Where a poor CEO can really wreak havoc on a stock very quickly.
The one thing I'll add, which is, for us, leadership is everything. It, like Kim said, like it starts at the top. And one of the things that really for us is really important, and for me personally, as I'm analyzing companies, I like to listen to the earnings calls. Like a lot of analysts will just read the earnings reports. To be able to, it's just like reading an email, right? Like people say, don't, an email can be interpreted different ways. You can't tell tone. You can't tell, things can be misinterpreted. To be able to actually listen to a CEO speak and the leadership team speak, you can really get a feel for, are they speaking with confidence? We like to buy companies that have good culture. Like, do you get a sense that they care about their employees? Like, good people at the helm and a good dynamic leadership team that's inclusive, they tend to produce good results. So, you do have those other situations like Michael was talking about with the bank CEO who shall not be named. Definitely not my favorite person, but you really have to go beyond and look at the leadership team, because it's really the team that's implementing the vision.
That's
What the vision.
Thank you for saying that, because I was going to bring that up, and I know Frank still has to talk here yet. But usually, it is a team. You're correct. I mean, the CEO decides who his team is going to be, but it's the rest of the staff right below him that has to implement all of his thoughts and ideas, depending on the size of the company, I guess. So, if a CEO is hired away, as this was in this case, if he doesn't take his team with him, can he be as effective? You probably can't answer that question, but because it probably depends on each.
There are other people who are capable of executing instructions. It's the visionary that's important. The executive, the man that moved or stayed, whichever, he has the vision. He directs the team. The team is good at execution. Consequently, it's not unimportant if he took some of his people, but he wouldn't have to. There are other good people that can be directed in the world. Give them the direction, they're excellent.
It's not unusual when a new CEO comes in, that leadership team is going to flip. At the end of the day, they might not, and there's a lot of issues like non-competes, and if you leave, you can't bring people and those sorts of things. But it's there will probably be a lot more turnover at the highest level.
And we won't necessarily see the headlines on that because it's not the CEO that is involved. One final question on this. Okay, a CEO can make a difference. In the case we're talking about this past week that happened, it was in the same kind of industry, if I'm not mistaken. But can you hire a CEO from one industry sector? Would he or she be as effective in the other?
Well, they hired a guy, I can't remember his name now. IBM hired like the CEO of Pepsi to come in and run it. And he did an okay job. IBM at the time was terrible, just terrible. So maybe it was just anybody, right? But I think if you have a vision and you can drive a team, it might work. But you have a lot riding against you because you have to figure out what's important to your customers. And I think that's the biggest thing. If that kind of dynamic can work from one industry to another, sure. But it is a larger risk.
Well, you bring up a good point, and very well may be this, and that is that whether the CEO is a visionary kind of CEO or whether he is a nose to the grindstone, making sure everybody's doing everything they need to have done, I suppose. So,
well, anyway. I mean, those skill sets are completely different. Yes. I think the biggest mistake that companies make is they take their really good managers, right, who are the executors, and make them CEO. Two completely different skill sets. Right. I'll give you a local example quickly. The Carnegie Museums. Steve Knapp, who runs Carnegie Museums, he's been there since 2020 because he started a month before the museum shut down. He was president of George Washington University. So the skill sets around, and he's amazing. He's a great leader. So, to Kim's point, you have to learn, you have to learn the customers but that skill set of leadership and vision and strategy is a skill set in and of itself.
Yeah.
All right, good. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We've been talking about rate cuts. We've been talking about CEOs and changing and how much effect they might have on a company. But we're going to change subjects again. So there are a lot of different ways for you to invest your money. If you follow us, then you know that my panelists believe that overall you invest for the long term. However, you have probably seen or heard the ads that if you put your money into options, it can be very lucrative. So, Frank, the question to you, options, thumbs up, thumbs down?
How about sideways, Stacy?
Okay.
They're pens. Options are a tool like everything else. And they are a tool that can be used to make a portfolio more conservative. They are a trading vehicle if you want to gamble. And I do mean gamble. All right. If you want to bet that the market, if you want to bet that NVIDIA is earnings are going to be fabulous again, and they're going to crush it, and their guidance is going to be crushing it as well, you probably could buy a call and make some money in a couple of days. However, if you're wrong, you'll probably lose all your money, because that's the problem with options. There's no real intrinsic value. The contract runs for a length of time. Now, I have used for years options as a income generator, a portfolio insurance device. I've never used it as a trading vehicle, which is what those ads are selling. They're selling excitement, just like the what's the name of that gambling operation that's every other ad? Well, now it's every fourth ad because the politicians have the rest of the ads.
You mean Robin Hood? I'm kidding.
That gambling, the casino companies, they're all selling ads. Gambling is exciting. It's not, in our view, I'll bet you there isn't a person that sits around this table that would say gambling is a good idea for investing.
Yeah.
All right.
Yeah. No, I agree with Frank. I mean, in my prior life, I was an options trader for like a hedge fund in Chicago. So I have a bit of experience there. But when it comes to the retail investor, we use options primarily, to Frank's point, in terms of either mitigating risk, or if you have a large, basically, if you have a large concentrated stock position, implementing some options is a good way to start trimming back that position, getting a little bit of income to help pay off your taxes, or using a put strategy to maybe mitigate some of the downside risk. I mean, it's mostly ways we do it to mitigate risk or to try to get out of a large concentrated position. Those Nigerian brothers who are promoting their book that you see on TV, is that what I'm talking about, is not for 99% of investors, in my opinion. To Frank's point, it's essentially not gambling, but it's not investing. I can tell you that.
In some of their strategies, you can actually lose more than you've put up. And that has got to be understood by anybody who thinks that there's some kind of free lunch to be had by using options. And most of what we're talking about, and what I'm a big believer in the costless collar for protecting large single holdings and selling them off over time. It's a beautiful thing, but it's not the same thing of what, it's not gambling at all. And if any of the strategies that can promise you great wealth can also destroy you. And I think that you need to know that if that's what you're considering.
Carrie, you want to wrap it up for us?
There's not much I can add to this. I totally agree. As Frank said, it's a tool in the tool chest. We use it all the time for protection purposes, generating income. For investors, the big question to always ask is, how much can I lose?
Yeah. And if you lose, as Frank pointed out, you lose on an option, you lose it all. And Kim's saying it maybe even more than that. So,
Right.
Which comes back to my favorite two words: risk versus risky.
yeah, those are
Risk
three.
is up and down, not go away.
But those are three words.
Risky is gone.
All right. Thank you once again for joining us, to Frank and Kim and Michael and Carrie. And we'll continue our look at investing and the economy in future editions. And again, I urge that if you watch this program, that you hit the subscribe or the like button, and we'll be able to continue this. And for right now, thanks again for joining us. We'll see you for the next edition of The Bull, the Bear, and You.